Welcome to the Deep Dive. Today we're plunging into a topic that's really reshaped conversations about money, tech, and freedom, Bitcoin. We've pulled together a stack of sources, articles, research, historical accounts to try and understand what Bitcoin is, where it came from, how it actually works under the hood, and why it matters today. Our goal in this deep dive, to cut through the noise, get you genuinely well-informed without feeling totally overwhelmed by all the complexity.
Exactly. We'll explore the foundational ideas, the technology that powers it all, and definitely look at the economic and social impacts. We'll be zeroing in on the most important insights from the material you've shared.
Great. So let's just jump right in. At its most basic level, what is Bitcoin?
Okay, so at its core, Bitcoin is a form of digital currency, often abbreviated as BTC. It was introduced way back in 2008 in a white paper by an unknown individual, or maybe a group, using the name Satoshi Nakamoto.
Ah, yes, the mystery figure. We'll get to that.
Precisely. And what sets it apart right away is its design. It operates on a peer-to-peer network. That means transactions happen directly between users, bypassing traditional middlemen like, banks or governments.
So no central authority?
None. This decentralized approach, it was a deliberate move. Seems like it was partly a response to the vulnerabilities everyone saw during the global financial meltdown in 2008.
So it's money that exists purely digitally, yeah? Not tied to a physical coin or anything?
Yes, purely digital. But it's not just a number in some bank's computer. It's underpinned by this transparent, distributed ledger called the Bitcoin blockchain. Think of the blockchain like a public record book, constantly updated, shared across thousands of computers. Every single Bitcoin transaction ever made is recorded there for anyone to see and verify. That transparency is really key to its security.
And I know a lot of the buzz around Bitcoin comes down to its supply. There's a hard limit, right? Only so many can ever exist.
That's a defining feature, absolutely fundamental to its whole economic model. The protocol itself dictates that a maximum of only 21 million Bitcoins will ever be created. This programmed scarcity, it's a stark contrast to traditional fiat currencies, which central banks can, theoretically create indefinitely.
And this is why people call it digital gold, that scarcity.
Exactly. That's a major reason for the comparison. And, for practical use, each Bitcoin is highly divisible, down to 100 million smaller units called Satoshis. The theory, or maybe the hope, is that if demand keeps rising against this fixed, diminishing supply rate, which gets affected by these halving events we'll talk about, its purchasing power could potentially increase over time.
It first appeared right after that 2008 crisis, back in 2009. And initially, the vision was more about payments, wasn't it? But that seems to have shifted.
Right. It was originally conceived as a peer-to-peer electronic cash system. That's what the white paper called it. But its role has definitely evolved. Increasingly, it's seen and used as a store of value, a bit like gold in that sense. Despite being digital, it actually shares many traditional money attributes. It's scarce, divisible, portable, durable, uniform, and non-counterfeitable because of the strong cryptography. And it is gaining acceptance, even if it's not yet universal for everyday payments.
Okay, let's circle back to that mysterious founder, Satoshi Nakamoto. This part of the story is just fascinating.
It really is one of the great mysteries of the digital age. Satoshi Nakamoto is almost certainly a pseudonym, their real identity, never confirmed. Despite tons of speculation, people debate if it's one person or maybe a whole group of developers. Some even think the Japanese-sounding name might have been, deliberate misdirection.
And this person, or group, they hold a significant amount of the early Bitcoin, don't they?
No. Estimates suggest Nakamoto controls Bitcoin addresses holding around 1 million Bitcoins. Though, importantly, those coins have never been spent, never moved. The implications of this anonymity are pretty significant. It reinforces the decentralized nature of the project right from the start. It prevents it from depending on a single leader figure. It really forces the protocol to stand on its own 2 feet, on its technical merits and network consensus, not someone's reputation.
And the core ideas were laid out in that document, the famous white paper.
Yes, published online October 31st, 2008, titled Bitcoin, a peer-to-peer electronic cash system. A really concise 9-page PDF.
The timing of that release feels incredibly deliberate, right in the thick of the financial crisis.
Absolutely. Putting it out precisely then, at the peak of the 2008 meltdown, strongly suggests it was a direct response. A response to the systemic risks, the institutional failures, the breakdown of trust in traditional finance that the crisis really laid bare. The revolutionary idea was this: a decentralized digital currency secured by cryptography to solve a major problem for digital money double spending without needing trusted third parties like banks.
So that double spending issue was the big hurdle for digital cash before Bitcoin. How did the white paper propose to fix it?
It introduced a system called proof of work combined with what it called a timestamp server, which is basically the blockchain technology we just discussed. This mechanism provided a way to have a secure, verifiable, and essentially unchangeable ledger on a peer-to-peer network. Everyone could agree on the transaction history and ownership without a central authority calling the shots. The focus was enabling low-cost transactions directly between people, bypassing the fees and control of the traditional financial players.
And the impact of that short paper has been just huge.
It's hard to overstate it, really. It led directly to the launch of the Bitcoin network in January 2009. But beyond Bitcoin itself, it inspired thousands of other digital assets, altcoins.
Right.
It catalyzed the entire field of blockchain technology. It fundamentally challenged the old financial ways and paved the way for what we now call decentralized finance, or DeFi. It showed that secure, decentralized value transfer was actually possible.
Okay, so how did it go from being this idea in a PDF to a functioning network? Where did it sort of digitally begin?
It kicked off with the very first block mined on the chain. It's known as the Genesis block, or Block 0. Satoshi Nakamoto mined it on January 3rd, 2009. That was the official birth of the Bitcoin blockchain, the first real-world implementation of that proof-of-work system, the absolute starting point.
And there's that famous message embedded right in that first block, isn't there? Kind of a statement.
Absolutely. Within the data of that first block's main transaction, the Coinbase transaction, Satoshi included this text. The Times 03 Jan 2009 Chancellor on brink of second bailout for banks.
Wow, that's pretty direct. Referencing the UK Chancellor and bank bailouts right there.
Precisely. It acts as an undeniable timestamp, proving the network started that day. But it's also clear commentary. It explicitly links Bitcoin's creation to the perceived failures of the traditional banking system and the government responses during the crisis. It subtly, but powerfully, highlights Bitcoin's purpose as a decentralized alternative, kind of embeds its philosophy right into Block 0.
A very deliberate choice of words. And those first 50 Bitcoins mined in that Genesis block, they were actually unspendable, weren't they?
Yes, that's right. Those initial 50 BTC are technically unspendable because of a quirk in how that first block was coded. While the exact reasons are debated, it symbolically suggests the creator was maybe focused on launching the system for everyone else, rather than immediate personal gain. Reinforces that idea of a fair launch.
The first actual transaction between people showing it worked, that came a bit later.
Correct. The first documented transfer happened when Satoshi Nakamoto sent 10 BTC to Hal Finney. Finney was a well-known computer scientist, an early adopter, really one of the first people to contribute to the Bitcoin project besides Satoshi. It was a crucial proof of concept, showed the peer-to-peer system worked.
So from those very early quiet beginnings, Bitcoin went from being known by just a handful of cryptographers to gaining global recognition. What were some key moments along the way?
Well, in 2009, it had basically no market value. The first time it was exchanged for something tangible, something in the real world, was May 22nd, 2010. That day is now famously called Bitcoin Pizza Day. A programmer named Laszlo Hanyecz paid 10,000 BTC for 2 pizzas that valued each Bitcoin at, fractions of a cent. But it was a landmark moment, Bitcoin's first step from just an idea to an actual medium of exchange.
10,000 Bitcoin for 2 pizzas. Thinking about today's prices, that has to be the most expensive pizza order in history. Easily.
Agrees. A legendary transaction, no doubt. Another significant milestone was hitting parity with the US dollar. $1 per BTC back in February 2011. And because Bitcoin's code was open source, it quickly inspired others. Early alternative coins, or altcoins, like Litecoins, started appearing, trying to improve on Bitcoin's design in different ways.
But it wasn't all smooth sailing. There was early controversy too, wasn't there? Things like Silk Road.
Yes. Bitcoin's early association with Silk Road, that infamous dark web marketplace, definitely brought negative attention and regulatory scrutiny, because it offered pseudonymity and direct P2P payments. But perhaps unintentionally, that whole episode also served as a powerful demonstration of one of Bitcoin's core tenets, censorship resistance. It showed how hard it was for any single entity to just shut down transactions. Around that time, in 2012, the Bitcoin Foundation was also set up to try and help standardize things and promote adoption.
Then came the first really big price surge, but also some major growing pains.
Right. 2013 saw the price shoot up, hitting $1,000 for the first time, grabbing more mainstream headlines. But then a huge crisis hit in 2014, the collapse of Mt. Gox. At the time, it was the world's largest Bitcoin exchange. About 850,000 Bitcoins belonging to users were lost or stolen.
Ouch. That must have been a massive blow to confidence.
It was severe. But it also hammered home a crucial lesson for users. Not your keys, not your coins. If you don't control your private keys, you don't truly own your Bitcoin. That spurred a lot of development in secure, user-controlled wallets. Also around this time, regulators globally started paying much closer attention. And a really important pre-programmed event happened, the first halving in November 2012. This event cut the reward miners get for adding a new block from 50 BTC down to 25 BTC. This halving schedule is baked into Bitcoin's code. It's a core part of its deflationary policy, slowing down the creation of new coins over time. We've had 2 more halvings since then. One in July 2016, dropping the reward to 12.5 BTC, and another in May 2020, down to the current 6.25 BTC.
The 2017 bull run. That
Yeah.
seemed to be when Bitcoin really exploded into mainstream awareness for many people.
It certainly did. The price went parabolic, nearly hitting $20,000. It attracted massive interest from retail investors. The sharp correction that followed was painful, yes, but it's a pattern we've seen with disruptive tech. That period also saw a growing focus on scaling solutions, like the Lightning Network, trying to figure out how to handle more transactions faster and cheaper off the main blockchain.
And then came what felt like a really pivotal moment. Big institutions started buying in.
Yes, that was a major shift. Companies like MicroStrategy, now just called Strategy, and even Tesla, they started adding significant amounts of Bitcoin to their corporate treasuries. And importantly, they weren't just trading it, they framed it as holding it as a reserve asset, like digital gold, to hedge against inflation. That was a huge step towards legitimization in the eyes of traditional finance. Since then, Bitcoin's hit new all-time highs, around $64,000 in late 2021. And more recently, soaring past $100,000, hitting figures like $108,388, even $111,891.30. As of early June 2025, it's hovering around $107,000. Prices are, of course, incredibly dynamic.
We also saw that brief kind of experimental phase where a country actually adopted it as legal tender.
That's right. El Salvador did that in 2021. The Central African Republic followed briefly, too. While those decisions were later reversed or significantly scaled back, it really highlighted the real-world potential, but also the immense complexities and challenges of trying to adopt Bitcoin at a national level.
So it's just been this incredible roller coaster ride. Innovation, crazy volatility, learning from huge mistakes like Mt. Gox, all leading to where we are now, with broader recognition, institutional players involved. Looking back at this whole history, the white paper, that Genesis block message, Pizza Day, Mt. Gox, the halvings, the institutions, jumping in, what's the main thread or insight that really stands out to you?
You know, what stands out most to me is this combination of its sheer technical resilience and its persistent, almost philosophical challenge to the traditional financial system. It was born from a crisis in centralized systems, right? And its whole history seems to be this constant dance between technical evolution, wild market swings, and this underlying message of decentralization and individual control over your money. Every setback, whether it's a major hack like Mt. Gox or regulatory crackdowns, seems to force the ecosystem to adapt, to become more robust, ultimately reinforcing that core idea that was literally embedded in the very first block.
Okay, let's peel back the layers now and really understand how this digital money actually functions. What's the technology stack that makes Bitcoin, well, Bitcoin?
Right. It relies on several key pieces working together. There's the blockchain ledger itself, the way transactions are processed, the system called mining, which uses proof of work, and the cryptography involving public and private keys.
And the absolute foundation, the bedrock, is the blockchain.
Yes, the blockchain is the engine. As we touched on, it's Bitcoin's public, distributed, and essentially immutable ledger. Imagine a giant shared spreadsheet, duplicated and stored on thousands of computers' nodes all over the world. It's a chronological chain of blocks, and each block contains a batch of verified transactions.
So it's not stored in one central place, which makes it decentralized.
Exactly. That decentralization is crucial. Because it's spread out globally, no single entity, no company, no government controls it. Its integrity, its accuracy is maintained by the collective agreement, the consensus of the network participants. This makes it incredibly resistant to censorship and avoids any single point of failure.
And how does it stay secure and unchangeable? How do we know past records aren't being messed with?
That's where cryptography is vital. Each new block added to the chain contains a unique digital fingerprint called a hash of the previous block. This cryptographically links them together like a chain. Now, if someone tried to alter even a tiny piece of data in an old block, its hash would completely change. And because the next block in the chain contains the original hash of that old block, the alteration would immediately break the chain. Tampering becomes obvious to the entire network. This linking is what makes it practically immutable. Once a transaction is confirmed in a block and more blocks are added on top, changing it becomes computationally infeasible, basically impossible.
And the transactions themselves, they aren't tied to people's real names, are they?
That's right. It's pseudonymous. Transactions are linked to Bitcoin addresses, these long strings of letters and numbers. Think of them like public account numbers. These addresses are derived from your public key, so anyone can verify transactions on the public ledger without knowing the real-world identity behind the addresses. Strong cryptographic algorithms, like SHA-256, secure all of this.
And how does this global network of computers all agree on which transactions are valid and the order they happened in? That seems complicated.
That's the job of the consensus mechanism. For Bitcoin, that's primarily proof of work, or POW, which is carried out through mining. Miners are the participants who bundle transactions into potential new blocks and then compete to add them to the official chain. For a block to be accepted by everyone, the vast majority of the network's computing power has to implicitly agree on its validity. This process, where the network collectively agrees on the chronological order of transactions, is what prevents things like double spending, all without needing a central authority. It's essentially achieving trust through computation.
Okay, that makes sense conceptually. Now let's trace an actual transaction. Say I want to send you some Bitcoin. What technically happens?
Okay, let's walk through it. A Bitcoin transaction is basically a digitally signed instruction. It tells the network you want to transfer ownership of a specific amount of Bitcoin from your control to someone else's address.
How is it signed? What does that mean?
You sign it using your private key. This is a secret, very long number generated randomly that only you should ever know or possess. It gives you complete and exclusive control over the Bitcoins associated with it. You use this private key to create a unique digital signature for that specific transaction. This signature mathematically proves you authorized the transfer without revealing the private key itself. The transaction data will also include the amount, the recipient's address, which comes from their public key, and critically, it references the specific unspent Bitcoins you're using as the source for this payment.
Unspent Bitcoins, like specific digital coins or notes.
Yeah, that's a good way to think about it. When you receive Bitcoin, it comes in chunks called unspent transaction outputs, or UTXOs. Think of them like individual bills or coins in your physical wallet. When you send Bitcoin, your transaction uses one or more of these UTXOs as inputs. If the total value of the UTXOs you use is more than the amount you want to send, the transaction also creates a new UTXO, sending the change back to one of your own addresses.
Got it. So I use my private key to sign the instruction, specifying the UTXOs I'm spending and your address as the destination. Then what happens?
That digitally signed transaction is then broadcast out to the Bitcoin network. Thousands of nodes around the world receive it and relay it to others. These nodes independently verify the transaction. They check your digital signature using your corresponding public key, which they can usually derive or is included to confirm you authorized it. And they check the blockchain's history to make sure the UTXOs you're trying to spend actually exist, belong to you, and haven't already been spent somewhere else. This validation step is crucial for preventing double spending.
If my transaction passes these checks, where does it go then? Does it immediately get added to the blockchain?
Not quite yet. If it's valid, it goes into a waiting area, a pool of unconfirmed transactions, often called the mempool. Miners then select transactions from this mempool to include in the next block they're trying to build. They usually prioritize transactions that offer higher fees, especially when the network is busy, because those fees go to them if they succeed. They bundle these selected transactions together, calculate a summary hash for all of them, called a Merkle root, include the hash of the last valid block, and add a special transaction called the Coinbase transaction, which is how they'll receive their reward if they mine the block successfully.
And this is where the actual mining part comes in, the competition.
Exactly. This leads us right into mining and proof of work. GATOBU. Miners dedicate huge amounts of computational power running highly specialized hardware, these days mostly ASICs, application-specific integrated circuits, to validate transactions and compete fiercely to be the one to add the next block to the blockchain.
What exactly are they competing to do? What's the work?
They're competing to solve a very difficult mathematical puzzle set by the Bitcoin protocol. It's essentially a massive, high-speed guessing game. A brute force search for a specific number called a nonce. They take the block data they've assembled, add a nonce, and run it all through a cryptographic hashing algorithm, SHA-256 twice. The goal is to find a nonce that results in a hash value that meets a specific target defined by the network. Typically, the hash has to start with a certain number of leading zeros.
So they're just trying trillions of numbers until one happens to produce the right kind of hash.
That's precisely what their specialized computers are doing, but on an absolutely astronomical scale. Finding that correct nonce is incredibly hard computationally. It requires immense processing power and consumes a significant amount of energy. We're talking trillions upon trillions of guesses per second across the entire network. But, and this is crucial, once a miner finds a nonce that works, it's extremely easy and fast for anyone else on the network to verify that the solution is correct. Just run the block data and the proposed nonce through the hash function once. This asymmetry, very hard to solve, very easy to verify, is the heart of proof of work. The work is the computational effort and energy spent finding that solution.
And the first miner to find that correct nonce, they win the right to add their block to the chain.
Yes. The first miner who successfully finds a valid nonce broadcasts their completed block proposal to the entire network. Other nodes quickly verify the nonce, check the transactions within the block again, and confirm it correctly links to the previous block. If everything checks out, they accept the block, add it to their own copy of the blockchain, and immediately start working on finding the next block, building on top of the one that was just accepted. The transactions included in that newly confirmed block get their first confirmation. As more blocks are mined and added on top of it, 2 confirmations, 3 confirmations, etc., it becomes exponentially harder to reverse those transactions. Many consider 6 confirmations a strong standard for finality.
And what's in it for the miners? Why do they spend all this money on hardware and electricity?
They get rewards for their successful work. There are 2 main components to this reward. First is the block reward. This is a set amount of newly created bitcoins generated by the protocol itself. Currently, it's 6.25 BTC per block. This reward amount gets cut in half roughly every 4 years through those halving events we mentioned. This is the only way new bitcoins are introduced into circulation.
And they also get the transaction fees.
Exactly. The second part of their reward is the sum of all the transaction fees attached to the transactions they included in their winning block. These fees are paid by the users who initiated those transactions. These combined incentives, the block reward and the fees, are designed to encourage miners to invest resources and participate honestly in securing the network.
You mentioned the puzzle gets harder or easier sometimes. How does that work?
Yes, that's a critical self-regulating feature called the mining difficulty adjustment. It happens automatically every 2016 blocks, which is roughly every 2 weeks. Its purpose is to keep the average time it takes for the network to find a new block consistent, aiming for about 10 minutes per block. This happens regardless of how much total computing power, or hash rate, is actively mining on the network at any given time. If lots of new miners join and blocks start being found much faster than 10 minutes, the difficulty of the puzzle automatically increases. If miners leave the network and blocks start taking longer, the difficulty decreases. This ensures a predictable and stable rate of new block creation and Bitcoin issuance.
So what does this whole proof-of-work system ultimately mean for Bitcoin's overall security?
It's absolutely fundamental to its security model. The massive amount of collective computing power, the global hash rate dedicated to mining Bitcoin, makes attacking the network incredibly difficult and economically irrational for the most part. Specifically, it makes the most well-known theoretical attack, the 51% attack, prohibitively expensive to pull off.
Right, the 51% attack. What could an attacker actually achieve if they did manage to control more than half the network's power?
Okay, if a single entity or cooperating group controlled over 50% of the network's total hash rate, they could potentially do a few harmful things. They could prevent new, legitimate transactions from getting confirmed. They might be able to selectively block transactions from specific addresses. Critically, they could attempt to reverse their own recent transactions, spending the same coins twice, which is the classic double spend attack. They could also potentially prevent other miners from finding valid blocks, essentially monopolizing block creation for a time.
But what can't they do, even with 51% control?
This is really important. Even with majority control, they cannot create new Bitcoins out of thin air beyond the standard block reward they'd earn, honestly. They cannot steal Bitcoins from addresses if they don't possess the private keys for those addresses. They cannot change old, deeply confirmed transactions from far back in the blockchain history. They cannot forge digital signatures to authorize transactions from wallets they don't control. And they cannot change the amounts or recipients in other people's valid transactions.
And how realistic is a 51% attack on Bitcoin today? given its size?
For Bitcoin specifically, because its network hash rate is so enormous and globally distributed, successfully mounting a 51% attack is considered extremely difficult and astronomically expensive. You'd need an unbelievable amount of specialized ASIC mining hardware, plus the massive amounts of electricity to run it all. On top of the sheer cost, there are powerful economic disincentives. Successfully attacking the network would almost certainly cause the price of Bitcoin to plummet, destroying the value of the attacker's own holdings and their huge investment in mining gear. Furthermore, the Bitcoin developer and user community could potentially coordinate a response, like changing the proof-of-work algorithm itself, which could render the attacker's expensive, specialized hardware instantly obsolete.
Have there ever been close calls where one group got near that 51% threshold?
Yes, there have been historical instances that caused concern. Most famously, a large mining pool called Gosh.io briefly approached, or maybe even momentarily crossed, the 50% mark back in 2014. However, widespread alarm within the community, and likely the pool operator's own self-interest in preserving the network's value, led to miners voluntarily redirecting their hash power to other pools to reduce that concentration. So while the threat is considered remote for Bitcoin due to its scale, it does constantly underscore the importance of maintaining decentralization in the mining ecosystem. Smaller cryptocurrencies, with much less hash rate securing them, have unfortunately fallen victim to 51% attacks, usually resulting in theft from exchanges via double spending and severe damage to their reputation. It really shows that proof-of-work security is directly proportional to the amount of honest computing power protecting the chain.
Okay, so the network itself, the core infrastructure, seems incredibly secure because of this combination of decentralization, cryptography, and the sheer economic cost of proof of work. But what about the individual user? That seems to be where most people run into trouble and lose funds.
Exactly. You've hit the nail on the head. User-level security is absolutely paramount, and frankly, it's often the weakest link in the chain. Remember that phrase, be your own bank? Well, that comes with the responsibility of securing your own funds. There's no bank support line to call if you mess up.
So what are the main ways individuals lose their Bitcoin? What are the biggest threats to users?
The primary risks usually involve either human error or falling prey to scams and malware targeting users directly. Big ones include phishing. Scammers create fake websites, emails, or social media messages that look legitimate, trying to trick you into giving up your private keys, your seed phrase, or your passwords. Malware is another major threat. Things like keyloggers that secretly record everything you type, clipboard hijackers that automatically swap a recipient's Bitcoin address with the attackers when you copy-paste, or viruses specifically designed to find and steal wallet files from your computer. Social engineering is huge, too. This involves psychological manipulation. Scammers might impersonate tech support, run fake giveaway scams playing on your fear of missing out, FOMO, or engage in sophisticated long-term pig butchering scams where they build trust and an emotional connection before convincing you to send them crypto.
Really highlights the human vulnerability aspect.
It absolutely does. Another major category is simply insecure key management. This includes using weak or reused passwords, storing your vital private keys or seed phrase digitally on a device connected to the internet like in a plain text file, an EMIS draft, or cloud storage, which is a huge no-no. Or having unsecured physical backups that could be lost, stolen, or damaged. Then there's exchange counterparty risk. If you leave your Bitcoin sitting on a cryptocurrency exchange, you're trusting that exchange. Your funds could be lost if the exchange gets hacked, mismanaged, or goes bankrupt, just like we saw with Mt. Gox. That mantra, not your keys, not your coins, is a direct warning about this specific risk. And SIM swapping is another concerning vector, where attackers trick your mobile provider into transferring your phone number to their device, allowing them to intercept verification codes sent via SMS, often used for two-factor authentication.
Okay, that's a daunting list of risks. So one of the absolute best practices, what steps must you take to protect yourself if you decide to hold Bitcoin?
The single most important thing, the absolute foundation, is to secure your private keys and your seed phrase, also called a recovery phrase. This is non-negotiable. If you're using a non-custodial wallet where you control the keys, write down your seed phrase on paper or etch it onto metal. Never store it digitally on any internet-connected device, ever. Keep multiple physical copies stored in different, secure, offline locations. Think of fireproof home safe, maybe a safety deposit box, but be aware of access issues there. And critically, Never, under any circumstances, share your seed phrase or your private keys with anyone or any website, no matter how convincing they seem.
Use hardware wallets. You mentioned those earlier.
Highly, highly recommended, especially for storing any amount of Bitcoin you can't afford to lose. Hardware wallets are physical devices specifically designed to keep your private keys completely offline, isolated from your internet-connected computer or phone. They require you to physically approve transactions on the device itself. Always make sure to buy hardware wallets directly from the official manufacturer or authorized resellers to minimize the risk of the device being tampered with before you receive it.
And just basic digital hygiene, strong passwords and all that.
Absolutely essential. Use strong, unique passwords for all your accounts, especially anything related to crypto. Enable robust two-factor authentication, 2FA, wherever possible. Crucially, prioritize app-based 2FA methods like Google Authenticator or Authy, or even better, physical security keys like a YubiKey, over SMS-based 2FA. SMS is vulnerable to those SIM swapping attacks we talked about. Be extremely vigilant online. Double-check website URLs before entering any sensitive information. Be deeply skeptical of unsolicited emails, messages, or calls asking for personal info, private keys, seed phrases, or urging you to take immediate action. Remember, legitimate services will never ask you for your seed phrase or private keys. Keep software up to date. Yes. Keep your computer's operating system, your browser, your antivirus software, and especially your wallet software itself up to date with the latest security patches. Only download wallet software from official, trusted sources, and commit to continuous education. The crypto space evolves rapidly, and so do the scams and threats. Staying informed is one of your best defenses. Limit the amount of Bitcoin you keep on exchanges to only what you need for active trading or short-term use. Understand fundamentally what Bitcoin is, how it works, and what it means to be responsible for your own keys.
And if, despite taking precautions, someone does get scammed.
It's a terrible situation. If you believe you've been a victim, report it immediately to the relevant law enforcement authorities in your country, like the Internet Crime Complaint Center, IC3, in the U.S. Provide them with as much detail as possible. Also, be extremely wary of any person or company that contacts you afterward or that you find online claiming they can recover your stolen funds, especially if they ask for an upfront payment. These recovery services are almost always scams themselves, preying on victims again.
Okay, moving beyond the tech and security, a huge part of the Bitcoin story, especially in recent years, is its role as an investment asset. One of the dominant narratives we keep hearing is digital gold.
Yes, the digital gold thesis is incredibly powerful and drives a lot of the investment interest. It positions Bitcoin as a potential store of value, a way to preserve wealth over time, and potentially as a hedge against inflation or currency devaluation. It draws direct comparisons to physical gold based on several shared characteristics.
What are those specific attributes that lead to the digital gold comparison?
The most frequently cited one is scarcity. Bitcoin has that hard programmed cap of 21 million coins ever. Gold is naturally scarce, though we don't know the exact total amount available. Both are considered durable. Gold physically resists decay. Bitcoin exists digitally on a resilient network. Bitcoin is arguably far more portable and easier to transfer globally than bulky physical gold. It's also infinitely more divisible down to tiny fractions, those satoshis. Both are gaining increasing recognition and acceptability as assets worldwide, and both are fundamentally verifiable and effectively non-counterfeitable gold through assaying, Bitcoin through its transparent blockchain and cryptography.
And the inflation hedge argument.
Yeah.
That seems central right now.
It's absolutely central, especially given the macroeconomic environment of the last decade or so. Bitcoin's fixed, predictable, and diminishing supply issuance schedule enforced by those halvings stands in stark contrast to fiat currencies, where central banks have the ability to expand the money supply significantly. Proponents argue this makes Bitcoin a way to potentially preserve purchasing power over the long term, particularly during periods of high inflation or when governments engage in large-scale money printing or quantitative easing, like we saw post-2008, and especially during the COVID-19 pandemic response. Now, while its effectiveness as a short-term hedge is definitely debated due to its volatility, its performance during some of these inflationary periods, viewed over longer time horizons, does lend support to the argument. But yeah, that short-term price swinginess can sometimes muddy the waters on this point.
Is it considered a traditional safe haven asset, though? Like some people view gold or certain bonds.
That's where there's still significant debate. Some proponents argue yes, precisely because it's decentralized and outside the direct control or manipulation of any single government or central bank. That makes it safe from political interference, in their view. However, its history of extreme price volatility makes many traditional investors and analysts, you see commentary from places like JP Morgan, expressing skepticism, hesitant to classify it alongside stable safe havens like gold. Some prefer to call it a speculative hedge, meaning it offers potential long-term protection due to its unique properties like scarcity and decentralization, but it comes bundled with significant volatility and the risks associated with a relatively new and still evolving asset class.
But the fact that major institutions are now holding it on their balance sheets, that must lend some credibility to the store of value idea.
Absolutely. When publicly traded companies like MicroStrategy, Now Strategy, or Tesla make strategic decisions to allocate billions of dollars of their corporate treasury reserves into Bitcoin, explicitly citing it as a hedge against currency debasement, that sends a powerful signal. It definitely adds significant credibility to the store of value narrative in the eyes of the broader market. We're even seeing reports of some U.S. states exploring the possibility of holding Bitcoin in their official reserves, which would be another major step in that direction.
Let's talk performance. Bitcoin's price history is, well, legendary for its explosive growth, but also equally famous for its terrifying drops.
Agrees. It's certainly been a wild ride. From essentially zero value in 2009 to fractions of a cent on Pizza Day 2010, hitting $1 in 2011, $1,000 in 2013, soaring towards $20,000 in the 2017 mania, then roughly $64,000 in late 2021, and more recently, as we mentioned, breaching $100,000, hitting highs like $108K, $111K, and settling around $107,000 currently in early June 2025. These are astronomical moves compared to traditional assets.
Those numbers highlight just incredible long-term growth if you held on.
They really underscore the extraordinary compound annual growth rates CAGR Bitcoin has delivered, especially for early adopters. One source we looked at cited a CAGR of over 100% in euro terms over a 13-year period. Comparing USD returns over different periods, over 5 years, Bitcoin reportedly generated a total return exceeding 1,000%, that's around 62% annualized, which starkly contrasts with gold's 96% total return and the S&P 500 index's 92% over the same time frame. Go back 10 years, and the difference is even more dramatic. Bitcoin's total return was close to 47,500%, roughly 85% annualized, compared to gold's 186% and the S&P 500's 184%. This massive outperformance is often attributed to its adoption curve as a completely new disruptive technology and monetary network starting from zero.
That growth comes packaged with that infamous volatility. You mentioned terrifying drops.
Absolutely. You can't talk about the growth without acknowledging the gut-wrenching volatility. While the long-term trend has undeniably been upward, the price swings along the way have been enormous. The deepest recorded drawdown, that's the percentage drop from a previous peak price to a subsequent low, was a staggering negative 76.7%. And that drawdown lasted for about 3 years and 1 month, from late 2013 to late 2016, so multi-year periods of being significantly down. However, despite that extreme volatility and those deep drops, it's worth noting that Bitcoin has managed to achieve positive annual returns in 10 out of its 13 full years of history, which is about 77% of the time. Its total market value, or market capitalization, has also grown immensely, exceeding $2 trillion at various points.
What actually drives this extreme price volatility? Why does it swing so wildly?
It's really a confluence of factors, many related to it still being a relatively young and unique asset class. Speculative trading plays a huge role. Prices react very quickly, often dramatically, to news, emerging trends, and shifts in market sentiment. This gets amplified by basic human emotions, fear, and greed. This leads directly to market sentiment swings, rapid rises, often fueled by FOMO, fear of missing out, and sharp sell-offs driven by FUD, fear, uncertainty, and doubt. It's incredibly sensitive to news and information. Positive news like major company adoption or favorable regulatory developments can send prices soaring, while negative news like security breaches or regulatory crackdowns can cause sharp drops. The evolving regulatory landscape globally is a primary source of uncertainty and therefore volatility. Broader macroeconomic factors also play a part, things like inflation expectations, central bank interest rate policies, global economic stability, even geopolitical events influence investors' appetite for risk assets like Bitcoin. Market liquidity, while growing, can sometimes be lower than in massive traditional markets like Forex or major stock indices. This means large buyer-sell orders can have a disproportionately large impact on the price. And increasingly, analysts watch on-chain metrics patterns of activity visible directly on the blockchain, like the behavior of large holders, whales, which can influence sentiment and price moves. Ultimately, it's still a nascent asset class. The market is still figuring out its true long-term value, its role in the financial system, it's undergoing price discovery, and that process is inherently volatile.
Are there specific ways analysts try to measure or understand this volatility?
Yes, they use various statistical metrics. Annualized volatility is a common one, and for Bitcoin, it's historically been extremely high, often in the range of 80% to 150% or even more, which dwarfs traditional assets like stocks or gold. Absolute daily volatility highlights how frequently Bitcoin experiences large single-day price swings, often more pronounced during bear markets. Rolling volatility tracks how volatility changes over specific time windows, helping to identify trends. More technical measures like skewness and kurtosis indicate that Bitcoin's price return distribution has fat tails. This means extreme price moves, both up and down, happen much more frequently than you'd expect in a standard bell curve distribution like you might see for large cap stocks. Risk-adjusted return ratios, like the Sharpe ratio, which compares return to total volatility, and the Sortino ratio, which compares return only to downside volatility, attempt to quantify whether the returns compensate for the risk taken. The Sortino ratio often looks more favorable for Bitcoin over long periods, suggesting that its high returns have historically outweighed its painful drawdowns for long-term holders. It's also interesting to note that the character of volatility can differ between market cycles. Bull markets sometimes see more controlled, trending upward moves, while bear markets often feature sharper, more chaotic swings and crashes.
So how does Bitcoin really stack up against traditional assets like gold and, say, the S&P 500 index when you compare them using these kinds of metrics?
Okay, looking at Bitcoin versus gold, both clearly share that store of value narrative, primarily based on scarcity. However, as we saw, Bitcoin has historically delivered vastly higher returns, but it comes with substantially greater volatility. Interestingly, Bitcoin has shown a lower correlation with assets like U.S. Treasuries compared to gold, which suggests it might offer better diversification benefits within a traditional portfolio, though this correlation is debated and seems to be changing over time as more traditional players enter the market. There's this underlying debate. Could Bitcoin's digital nature, its ease of transfer, its programmability eventually challenge gold's centuries-old status as the premier non-sovereign store of value? That's a big question the market is grappling with.
And compared to stocks like the S&P 500.
Bitcoin versus equities, represented by the S&P 500. Again, Bitcoin has massively outperformed the stock market over most multi-year horizons, but with far, far higher volatility. Historically, Bitcoin has had a relatively low correlation to the S&P 500, which again pointed to potential diversification benefits. However, that correlation seems to have increased, especially during times of market stress, as more institutional capital flows into Bitcoin and treats it more like other risk assets.
So what are the implications for someone thinking about including Bitcoin in their investment portfolio?
Well, for portfolio construction, the theory is that adding a small allocation of an asset with low correlation but high potential returns, like Bitcoin, could potentially boost the overall risk-adjusted returns of the portfolio. However, due to its extreme volatility, that allocation size must be kept small. We're talking about a percentage of your total portfolio that you are genuinely comfortable potentially losing entirely, given the inherent risks. Don't bet the farm. The core investment theses really differ. Gold is primarily seen as a traditional store of value, an inflation hedge, a safe haven. Equities are mainly about participating in economic growth through company earnings. Bitcoin kind of blends aspects of both. It has that digital gold narrative, store of value, inflation hedge potential, combined with the characteristics of a high-growth, disruptive technology asset. Its risk profile is arguably much closer to early-stage venture capital than it is to traditional gold or bonds.
Okay, given all that potential reward, but also the clear risks, what are the absolute key dangers someone needs to be acutely aware of if they're considering investing in Bitcoin?
The risks are definitely significant and varied. The most obvious one is price volatility. The potential for sudden, sharp, and deep price drops is always present. Regulatory risk is huge and ongoing. The global regulatory landscape is still evolving, inconsistent, and uncertain. Potential government bans, crackdowns on exchanges, changes in tax laws, or how Bitcoin is legally classified could all severely impact its price, adoption, and usability. Security risks at the user level are critical and, frankly, often underestimated by newcomers. We talked about phishing, malware, social engineering, but the biggest user risk is often inadequate self-custody practices and poor private key or seed phrase management. Remember, if you hold your own keys, you are the primary target for thieves, not some central institution.
And relying on exchanges adds another layer of risk.
Yes, exchange counterparty risk is a major one. If you choose to leave your Bitcoin on a cryptocurrency exchange or any other custodial service, you are trusting that third party. Your funds are vulnerable if that company gets hacked, mismanaged, experiences technical failures, or becomes insolvent. The ghost of Mt. Gox looms large here, constantly reminding us, not your keys, not your coins. Wasawa. There are also potential technological risks, the possibility of unforeseen bugs in the core protocol, challenges in scaling the network effectively, or vulnerabilities discovered in related software or infrastructure. Market sentiment itself is a risk. The market can be driven by hype cycles, leading to unsustainable bubbles followed by painful crashes. There's competition from thousands of other cryptocurrencies and blockchain projects, some claiming technological advantages. The environmental concerns surrounding proof-of-work's energy consumption are real and could lead to negative public perception or regulatory action. And compared to assets like gold or stocks, Bitcoin has a relatively limited history, meaning less long-term data to analyze its behavior across different economic cycles.
So with all those risks, what are the strategic considerations or maybe best practices for someone approaching Bitcoin as a potential investment?
First and foremost, adopt a long-term perspective. Trying to actively trade or time the market with such a volatile asset is incredibly difficult and risky, especially for non-professionals. Determine an appropriate portfolio allocation. Given the risks, keep it to a small percentage of your overall investment portfolio, an amount you could genuinely afford to lose without jeopardizing your financial goals. Many investors find dollar cost averaging, DCA, to be a sensible approach. This involves investing a fixed amount of money at regular intervals, say weekly or monthly, regardless of the price. It helps average out your purchase price over time and reduces the risk of buying everything at a market top. Crucially, prioritize self-custody and security. If you decide to hold Bitcoin directly, learn how to use non-custodial wallets, especially hardware wallets, for significant amounts. Understand how to securely back up and store your seed phrase offline. Take responsibility for your own security. Commit to continuous education. This market is complex, it changes fast, and it's filled with misinformation. Stay informed from credible sources. Understand what you own. Don't just buy it because the price is going up. Understand its properties, its technology, its risks, and why you're investing in it. And finally, be extremely Batgirl. Beware of hype and scams. If something sounds too good to be true, like promises of guaranteed high returns, it almost certainly is, be skeptical.
And that institutional involvement we discussed earlier, does that change the risk profile?
It's a double-edged sword. On the one hand, institutional involvement could bring more liquidity, potentially dampen volatility over time, and add legitimacy. On the other hand, it could also introduce new systemic risks if, for example, ownership becomes highly concentrated among a few large players, or if the market becomes overly reliant on regulated institutional custodians, potentially re-centralizing aspects of the ecosystem. It's definitely something to watch closely as it unfolds.
Wow. Okay, we've journeyed from that mysterious white paper born out of the '08 crisis, gone deep into the tech of how it works and how to keep it safe, looked at its incredibly volatile but also impressive history as an investment, and covered the significant risks. It's really clear Bitcoin is so much more than just a ticker symbol or a price chart. It's this complex ecosystem driven by technology, economics, and a potent set of ideas. Looking forward now, what are the key factors you see shaping Bitcoin's future path?
Yeah, looking ahead, several key areas seem critical. There's the ongoing development of scalability solutions to handle more users and transactions. There's the predictable programmed economic impact of future halvings. There's the dynamic role played by its decentralized communities, both developers and users. And then there's how it navigates significant external challenges, particularly around environmental concerns and the ever-evolving regulatory landscape.
You mentioned scalability challenges earlier. The base layer, layer 1, being limited in how many transactions it can process per second due to things like the 10-minute block time and the block size limit. What are these layer 2 solutions doing to tackle that?
Right. Layer 2 solutions are essentially protocols built on top of the main Bitcoin blockchain, layer 1. Their goal is to increase the network's transaction capacity, drastically reduce fees, and sometimes add new functionalities, all without needing to make fundamental changes to the core Bitcoin protocol itself, which is often difficult and contentious to do. They generally work by processing the bulk of transactions off the main chain, only using the secure base layer, layer 1, for essential things like opening connections or for final settlement of balances.
And the most talked about layer 2 is the Lightning Network, right?
Yes, the Lightning Network, LN, is definitely the most prominent and widely deployed layer 2 solution for Bitcoin payments today. It enables incredibly fast, near instantaneous, and very low-cost transactions by creating payment channels between users. Essentially, two users lock up some Bitcoin in a special transaction on layer 1 to open a channel between them. Once the channel is open, they can send potentially thousands of transactions back and forth between each other almost instantly and with negligible fees, all off-chain. Only the final net balance needs to be recorded back onto the main blockchain when they decide to close the channel. Payments can even be routed across a network of interconnected channels, allowing you to pay someone you don't have a direct channel with. It's particularly well suited for small, frequent payments like buying coffee or online content.
So it really aims to solve the speed and fee problems for everyday, smaller transactions.
Dramatically so, yes. It provides a massive increase in potential transaction throughput compared to the base layer. Confirmations happen in seconds, not minutes or hours. And the fees are typically fractions of a cent, making micropayments economically viable for the first time on Bitcoin. Remember that example we heard about the vegetable vendor in Kibera, Kenya, receiving near fee-free payments? That kind of use case is almost certainly enabled by the Lightning Network.
But these Layer 2 solutions like Lightning, they have their own hurdles or challenges too.
They absolutely do. It's still relatively early days. Challenges remain in areas like user experience, making it as simple to use as on-chain transactions, although this is improving rapidly. Ensuring sufficient liquidity within the network's channel so payments can route successfully is another ongoing task. Payment routing itself can be complex. Also, for users running their own non-custodial Lightning wallets, there's often a need to be online to reliably receive payments directly. And some critics raise concerns about the potential for centralization around large, well-connected routing hubs within the Lightning Network, though the network is designed to be decentralized. Besides Lightning, there are other Layer 2 concepts being explored too, like generalized state channels or sidechains, although sidechains often come with different security models and trade-offs compared to inheriting the full security of the Bitcoin base layer. Overall, Layer 2 development is seen as crucial if Bitcoin is to expand its utility significantly beyond just being a store of value.
Let's go back to the halvings, these programmed events that cut the supply. How will they continue to shape Bitcoin's economics and future trajectory?
The halvings are a really fundamental, hard-coded part of Bitcoin's monetary policy. As we established, they happen roughly every 4 years, specifically, every 210,000 blocks mined. Each halving cuts the block reward, the amount of new Bitcoin created with each block, exactly in half. We've seen it go from 50 BTC initially down to 25, then 12.5, and now it's currently 6.25 BTC per block. The next halving is expected sometime around late 2024 or early 2025, and that will reduce the reward again, down to 3.125 BTC per block. This process is scheduled to continue roughly every 4 years until around the year 2140, at which point the block reward will become negligibly small, and the total supply of Bitcoin will be extremely close to that 21 million hard cap.
What's the primary economic effect everyone focuses on?
The main impact is supply reduction. Each halving acts as a predictable supply shock, drastically reducing the rate at which new Bitcoins enter the market. This mechanism automatically reinforces Bitcoin's scarcity and its pre-programmed deflationary nature over time. Historically, these halving events have shown a strong correlation with significant historical price increases in the months leading up to and following the event. We saw this pattern after the 2012, 2016, and 2020 halvings. This fuels a lot of speculation and market narratives based on simple supply and demand economics. If supply growth slows while demand stays constant or increases, the price should theoretically rise. But it's crucial to stress, past performance is absolutely no guarantee of future results. Market conditions can change.
How does it directly affect the miners who secure the network?
It has a direct and significant impact on miner economics. It immediately cuts their primary revenue stream, the block reward, in half overnight. This puts immense pressure on less efficient miners, potentially forcing them out of business if the Bitcoin price doesn't rise sufficiently to compensate. This can lead to shifts in mining concentration or incentivize miners to seek out regions with the absolute cheapest energy costs. The halving event itself is always highly anticipated within the market and tends to fuel bullish narratives among investors and analysts. It strongly reinforces that digital gold thesis by visibly demonstrating Bitcoin's predictable, algorithmically diminishing supply, especially when contrasted with the discretionary policies governing fiat currencies.
Now, Bitcoin famously doesn't have a headquarters, no CEO, no board of directors making decisions. So who actually guides its development? Who keeps the network running and evolving?
That's really the heart of its decentralized design. Its direction and ongoing operation are guided by its distributed Bitcoin developer and user communities. It's a collaborative, sometimes messy, process.
Tell me more about the developer community first. Who are they? How do they operate?
The developer community is a global, decentralized group of software engineers, cryptographers, and researchers who contribute primarily on an open source basis. The main software client they work on is called Bitcoin Core, but there are other implementations too. There's no single leader or company in charge. It operates largely as a meritocracy, where influence comes from the quality of contributions and the ability to build consensus. Their roles include maintaining and updating the core protocol software, fixing bugs, proposing and implementing improvements, often through a formal process involving Bitcoin improvement proposals, or BIPs conducting rigorous code reviews and researching potential future enhancements. Collaboration happens openly and publicly on platforms like GitHub, through mailing lists, and in online forums. Major decisions about changes to the protocol are typically reached through a process of rough consensus among the various stakeholders, including developers, miners, users running full nodes, and major businesses in the ecosystem. This consensus-driven process is intentionally slow and conservative by design. It's meant to prevent any single entity from making unilateral changes and to ensure that any modifications are technically sound, safe, and broadly supported by the network. They are absolutely crucial for maintaining the technical integrity and guiding the careful evolution of the protocol over time.
Okay, and what about the user community? What role do they play?
The user community is essentially everyone else who interacts with Bitcoin individuals holding it. Merchants accepting it for payment, investors trading it, businesses building services on top of it, people running full nodes to validate transactions independently. They are equally vital. They are the ones who drive adoption and contribute to the powerful network effect, the idea that the network becomes more valuable as more people use it. They provide real-world feedback on usability, identify new use cases, and their collective actions, buying, selling, holding, using, significantly influence the price and market dynamics. Grassroots advocacy and education efforts, often driven by passionate users, are also a huge part of the ecosystem's growth. Their economic activity, whether it's transacting or dedicating resources to run a full validating node, contributes directly to the network's vitality and, importantly, its decentralization. The wide distribution of Bitcoin ownership among millions of users globally also inherently contributes to its resistance to control.
So it sounds like both communities are completely indispensable for Bitcoin to function and thrive.
Absolutely. They are two sides of the same coin, completely interdependent. The developers provide the technical foundation, ensure the protocol's soundness, security, and careful evolution. The users provide the economic lifeblood, the network effects, the real-world demand, and the ultimate reason for the network to exist. Their interaction, which often involves open, vigorous, and sometimes quite contentious debate about the best path forward, is really a hallmark of Bitcoin's unique, decentralized governance model in action.
We absolutely have to talk about the environmental impact, specifically the energy consumption tied to proof-of-work mining. It's a major criticism and a significant ongoing concern.
Yes, it's a widely discussed and entirely legitimate concern. Proof-of-work mining, because it relies on that intense computational competition to secure the network, is inherently energy-intensive. It requires vast amounts of electricity to power the specialized ASIC mining hardware running 100 to 47. Annual estimates for Bitcoin's total network energy consumption vary quite a bit depending on the methodology, but they often fall in the range of 90 to 150 terawatt hours, TWH, per year. That's comparable to the energy consumption of entire medium-sized countries like Argentina or the Netherlands. One source we saw estimated around 138 TWH as of 2025, representing perhaps 0.5% of total global electricity consumption.
And the resulting carbon footprint depends heavily on where that electricity is generated.
Exactly. The carbon footprint becomes a significant concern when that electricity is generated using fossil fuels like coal or natural gas. Estimates for the carbon footprint also vary, with one source setting around 39.8 million metric tons of CO2 equivalent per year, which is roughly 0.08% of total global emissions. The actual carbon intensity of Bitcoin mining varies dramatically depending on the energy mix used by miners in different geographic locations. For example, when China cracked down on mining, a lot of miners moved to places like Kazakhstan, which relied more heavily on coal, and that reportedly increased the network's overall carbon footprint temporarily. There are also related environmental concerns about e-waste from mining hardware that quickly becomes obsolete, and the potential water footprint associated with cooling large mining facilities and generating the electricity itself.
What's a context or the counter-arguments that are often presented regarding this high-energy use?
Well, proponents often argue a few key points. First, while the energy cost per individual transaction might seem high if calculated naively, The energy is primarily being spent to secure the entire multi-trillion-dollar network and validate the integrity of the whole ledger through the proof of work process. They argue this energy expenditure is fundamental to Bitcoin's security, decentralization, and its ability to create digital scarcity, and it's unlikely to be changed without compromising those core properties. Second, there's evidence of a significant and growing trend towards miners utilizing renewable energy sources. Some studies, although often debated, suggest that over 50% of Bitcoin mining energy already comes from renewables like hydro, wind, solar, or geothermal. Miners are strongly economically incentivized to seek out the absolute cheapest sources of electricity available, and these are often stranded renewables power generated in remote locations that can't easily or economically be transported to major population centers. Some even make the argument that Bitcoin mining could actually support the development of new renewable energy projects by providing a consistent buyer of first resort for power that might otherwise be wasted or curtailed, helping to make those projects more economically viable. We're also seeing industry initiatives focused on carbon offsetting, promoting green crypto mining practices, and increasing transparency about energy sources. Ultimately, the argument often boils down to weighing the energy cost against Bitcoin's perceived value proposition as a decentralized, censorship-resistant, global monetary network or store of value worth the energy it consumes. All complex systems that provide valuable services have energy costs. The question is whether Bitcoin's benefits justify its particular cost.
It's clearly a very complex issue. Lots of technical, environmental, and economic factors tangled together.
It really is. The future focus in this area will likely involve continued scrutiny from regulators, like the U.S. Environmental Protection Agency looking into miner emissions, ongoing efforts within the industry for greater transparency about energy mix, hopefully increasing adoption of sustainable energy sources, and the continuous development of more energy-efficient mining hardware over time. It represents a fundamental tension between the need for robust security, which in POW is tied to energy cost, and pressing global sustainability goals.
Okay, let's tackle another common perception, or maybe misconception, the association with illicit activity. Is Bitcoin mainly a tool for criminals?
Bitcoin definitely gained an early association with illicit activity, most notably because of its use on the Silk Road marketplace back in the day. That unfortunately created a lasting public perception. And yes, Bitcoin has been used and continues to be used to some extent for facilitating payments on darknet markets, for ransomware demands and various scams, for money laundering, and potentially for sanctions evasion. The reasons often cited are its decentralized nature, no central authority to block payments, its relatively fast and irreversible transactions, and a perceived, though often overstated, level of anonymity, although users often employ techniques like coin mixers to try and obscure the trail of funds.
But the data seem to tell a different story about the proportion of illicit use.
Crucially, yes. Data from reputable blockchain analytics firms who trace transactions on the public ledger consistently shows that the proportion of overall Bitcoin transaction volume linked to known illicit activities is relatively small and has generally been declining over time. For instance, one source we consulted reported that in 2024, addresses associated with illicit activities received around $40.9 billion worth of crypto. That sounds like a lot, but it represented only about 0.14% of the total on-chain transaction volume measured that year. That percentage is down from estimates around 0.61% in 2023, and historically, the figure has consistently remained well below 1% of total volume.
And are illicit actors increasingly using other types of digital assets instead of Bitcoin?
Yes, that's another important trend highlighted by the data. While Bitcoin might still be preferred for certain specific niches like ransomware payments or darknet market transactions, reports indicate that the majority of illicit transaction volume in the crypto space actually now flows through stablecoins, cryptocurrencies pegged to fiat currencies like the US dollar. One source suggested stablecoins accounted for around 63% of illicit transaction volume in 2024, which mirrors the broader trend of stablecoins gaining dominance for general transaction purposes in the crypto market due to their price stability. And it's also vital to counter the myth of Bitcoin's untraceability. Contrary to early perceptions, because every single transaction is permanently recorded on the public immutable blockchain, Bitcoin transactions are actually highly traceable. Law enforcement agencies and specialized analytics firms have become very adept at following the flow of funds on the blockchain, often more effectively than they can trace physical cash. The main challenges remaining are typically linking those pseudonymous blockchain addresses to real-world identities and navigating the complexities of international legal cooperation.
So it sounds like the public perception, maybe shaped by early headlines, is often quite different from the reality shown by the transaction data.
Exactly. The role of Bitcoin in illicit activity, while real, is frequently overestimated in public discourse compared to the data. The actual percentage of illicit volume relative to total volume is low and appears to be declining. Illicit actors are increasingly shifting towards other assets like stablecoins. And the traceability of Bitcoin transactions for investigative purposes is far greater than often assumed.
Okay, finally, let's talk about regulation. This feels like a huge looming factor for Bitcoin's future. Where does the regulatory landscape stand globally right now, and where does it seem to be heading?
It's an incredibly complex, dynamic, and frankly, highly fragmented picture. Regulatory approaches to Bitcoin vary significantly from one country or jurisdiction to another. There's a growing consensus, though, that more regulatory clarity is needed as the market matures and becomes more intertwined with the traditional financial system.
What does the current situation look like? What are the main characteristics?
Right now, it's largely a patchwork quilt globally. You have some jurisdictions that have tried to embrace Bitcoin and crypto, providing relatively clear legal frameworks, like Switzerland or Singapore in some aspects. Others have taken a much stricter stance, imposing tight controls or even outright bans on mining or trading, like China. A major challenge is that the rapid pace of technological innovation in the crypto space consistently outpaces regulators' ability to fully understand the implications and develop appropriate rules. Bitcoin's inherently decentralized nature also fundamentally challenges traditional regulatory models, which typically rely on identifying and supervising centralized intermediaries like banks or exchanges. So, regulators worldwide are currently grappling with this difficult balancing act: how to foster the potential benefits of innovation while also fulfilling their mandates to protect consumers, maintain financial stability, and prevent illicit activities like money laundering and terrorist financing.
Are there some key trends emerging in how regulators are approaching Bitcoin and crypto?
Yes, several key trends are becoming apparent globally. There is a strong focus on consumer protection, aiming to shield retail investors from fraud, scams, market manipulation, and the risks associated with extreme volatility. This often involves stricter requirements for exchanges regarding disclosures, security standards, and segregation of customer assets. Anti-money laundering, AML, and counter-terrorist financing, CFT regulations, are being broadly applied to crypto exchanges and other virtual asset service providers, VASPs, generally requiring them to implement robust Know Your Customer, KYC procedures, to identify their users, similar to traditional banks. There's growing regulatory attention specifically on stablecoin regulation, given their increasing systemic importance, focusing on requirements for reserves, transparency, and operational resilience. Regulators are also increasingly focused on ensuring market integrity by tackling issues like market manipulation and insider trading. Providing clarity on the taxation of Bitcoin transactions and holdings is another major area of focus in most countries. We're also seeing increasing international cooperation, with bodies like the Financial Action Task Force, FATF, setting global standards for crypto regulation, and regional blocs like the European Union implementing comprehensive frameworks like MiCA, Markets and Crypto Assets Regulation. And interestingly, regulators themselves are increasingly using technology like sophisticated blockchain analytics tools and AI to monitor the crypto space for illicit activity and enforce compliance.
So looking ahead, say towards 2025 and beyond, what's the likely direction for Bitcoin regulation? More rules? Less?
The general trend seems to be pointing towards more clarity and the development of more comprehensive regulatory frameworks globally, rather than outright bans in most major economies. As the industry matures and interacts more with traditional finance, the pressure for clear rules of the road increases from both regulators and industry participants themselves. We can likely expect increased collaboration between regulators and the crypto industry as both sides gain more understanding. There's also bound to be a growing focus on how to effectively regulate the even more complex and decentralized world of DeFi, decentralized finance, which often interacts with Bitcoin. It's definitely a rapidly evolving area where the final rules are still very much being written, and how Bitcoin navigates and adapts to this evolving regulatory environment will be absolutely key to its future trajectory and mainstream acceptance.
Wow. Okay, we have covered a remarkable amount of ground in this deep dive. We've traced Bitcoin's origins right back to that mysterious white paper and the symbolic message in the Genesis block. We've dived deep into the complex technology, the blockchain, transactions, mining, proof of work. We've looked at the critical importance of user security and actually managing your own keys. We've analyzed its incredibly volatile but potentially transformative role as an investment asset, alongside all the significant risks involved. And we've looked ahead at how things like scalability, the halvings, the power of its communities, and major challenges like environmental impact and regulation will likely shape its future. It's crystal clear that Bitcoin is far, far more than just a volatile price ticker flashing on a screen. It's this incredibly complex system, born out of a very specific historical moment, representing a unique fusion of technological innovation, economic theory, and really a distinct philosophy about money and control.
Indeed. It fundamentally represents a different way of thinking about money, about trust, about control, especially when compared to the traditional financial systems we've relied on for centuries. It undeniably offers real potential for innovation and financial empowerment in some contexts, but as we've discussed, it also comes bundled with significant risks, unresolved challenges, and ongoing, deeply complex debates that need careful consideration and navigation by users, developers, and policymakers alike.
Absolutely. So think about everything we've unpacked today. Its core design around a fixed supply, driving scarcity, the inherent energy cost tied directly to its security model, the ongoing challenges of trying to scale it for mass use while preserving its decentralization, that constant tension between empowering individual financial sovereignty and meeting the demands of global regulation. Here's a final thought, maybe a question for you listening to consider. Bitcoin was fundamentally designed as a permissionless system where trust is meant to be achieved through cryptographic proof and computation, explicitly bypassing the need for trusted institutions. As it continues its journey towards broader mainstream adoption and faces increasing pressure to integrate with the existing regulated financial world, how will these core design principles, this reliance on code and consensus over intermediaries, either clash with or perhaps adapt to the demands of a global system still largely built on trust in established institutions like banks and governments?
Can a system fundamentally born from distrust in intermediaries ever truly coexist comfortably with, or perhaps even reshape, the very institutions it was originally designed to circumvent?
That really is the multi-trillion-dollar question, isn't it? It encapsulates so much of the tension, the debate, and the innovation happening in this space right now. It's certainly something fascinating and incredibly important to keep a very close eye on as this technology and its surrounding ecosystem continue to evolve in the years ahead.
Absolutely. Well, we certainly hope this deep dive has provided you with a clearer, more nuanced picture of Bitcoin's multifaceted nature, and perhaps empowered you with the knowledge to better understand its past, its present, and its complex potential future. Thanks so much for joining us. We'll see you next time on The Deep Dive.